Have you heard about the largest Ponzi scheme ever? And no, I'm not talking about Bitconnect. This one involved a charming Wall Street wizard who supposedly had the Midas touch. A man who conned thousands of investors, including celebrities, corporations like HSBC Holdings, and prominent businessmen. He even managed to hoodwink regulators and keep that scheme running for decades. It's the topic of this video, a story of deception, fraud, and misplaced reputations, which shook the traditional financial system to its core. It's a cautionary tale that you cannot afford to miss. Before I dive in, I want to make sure that the vibes are just right. So, this video is for entertainment and educational purposes only. All information contained herein is drawn from publicly accessible sources. Now, with that preamble out of the way, I want to salute all the new viewers on the channel today. My name is Guy, the Crypto Guy, and I'm the main guy over here at the Coin Bureau. Me and my wonderful team work day and night to bring you the highest quality content on the tube. News, reviews, overviews, and market moves too. If that sounds like something you want to tune into, then smack that subscribe button and whack that bell as well. That way, those YouTube chaps will alert you when this lad is back. So, are you ready to hear about that $65 billion Ponzi? Well, let's start scaling the pyramid. To kick things off, I'm going to quickly go over what a Ponzi scheme is. In short, it's a fraudulent investment scheme which pays out existing investors with funds collected from new investors. Typically, high investment returns are promised with little to no risk. Naturally, as there's no real revenue generated by these schemes, a constant stream of new money is required to keep the Ponzi going. Now, it's true that many people have given crypto a hard time and associated it with Ponzi schemes in the past, the most famous of which is probably Bitconnect! That saw investors lose around $2 billion when it came crashing down. Now, that is a boatload of money. However, it pales in comparison with the $65 billion Ponzi that Bernie Madoff pulled off on Wall Street. What's even crazier is that no one even knows how long Bernie's Ponzi was running for. In a CNN interview, he once said that it all started in 1987, then later changed that to 1992. Some say that Madoff may have started it all the way back in the 1960s when he first began working on Wall Street. Indeed, one ex-Madoff employee called Frank DePascali admitted in court that he had been creating fake books and records for 33 years at Madoff's firm. Madoff also pleaded guilty to securities fraud, investment advising fraud, perjury, international money laundering, income tax evasion, wire and mail fraud. So yeah, it seems likely that this giant Ponzi scheme had been running for decades. The story ended in 2021, with the one-time Wall Street titan dying in prison of natural causes. This was after he had been sentenced to 150 years behind bars back in 2009. Indeed, it was this kind of skullduggery, rife in the financial sector, which helped prompt the creation of Bitcoin in the first place. Yes, Bernie Madoff was a crook almost without compare, who devastated the lives of thousands of victims, resulting in suicides, bankruptcies, and home losses. This was a man who had no issue scamming even charitable entities like the Wiesel Foundation for a whopping $15 million. That foundation focused on combating indifference, intolerance, and injustice through international dialogue and youth-focused programs. The foundation was founded by Holocaust survivor Elie Wiesel and his wife and was established after he won the Nobel Prize for Peace. The point is that Bernie Madoff didn't even have a perverse type of Robin Hood code of ethics for whom he scammed. It really did seem to be anyone and everyone that had access to huge sums of money. But how exactly did this Ponzi work? Well, let me tell you. Now, honestly, Madoff's scheme was rather straightforward. He essentially created an account in which his investment firm collected funds from clients and used that same money to pay out those clients who wanted to liquidate their holdings. No actual trading ever took place. Instead, Bernie would magic up a percentage return that his investors earned in any given month and use historical price data to reverse engineer which trades his firm would have had to have made in order to achieve that rate of return for his clients' accounts. Now, do you remember that chap Frank DePasquale that I mentioned earlier? The one who claimed that he'd been creating fake records for 33 years? Well, it was Madoff or DePasquale who would enter in bogus trades with real prices into an ancient IBM computer that he used for his advisory business. Then bang, all those investors had gotten those returns and the fund had its track record, at least on paper. So that was essentially how Madoff was able to create the illusion that he had the Midas touch and was able to generate those great returns for his investors. Now that farce could be sustained for as long as withdrawal requests could be covered by the money sloshing around in that account. In normal circumstances, that seemed to have been no problem at all. But 2008 was a pretty disastrous year for the financial sector, which saw stock markets plummet and investors get spooked. It was that which ultimately resulted in the end of Madoff's Ponzi scheme, with investors in his funds attempting to withdraw around $7 billion. Naturally, by November 2008, very little money was flowing into these funds, and that led to Madoff failing to cover the volume of withdrawal requests. And that's how this house of cards finally came tumbling down. Oh yes, another interesting fact is that even though most people refer to this crime as the $65 billion Ponzi scheme, that figure was only arrived at because Madoff generated fake account statements to his investors, telling them that they were collectively worth $65 billion in total. The actual amount of money he stole in principal funds was $20 billion. So yeah, that extra $45 billion was nothing more than the figment of Madoff's imagination. Now, I know what you're thinking. Surely, with a scheme as large as this, there would be some warning signs that all was not as it should be. Well, indeed there were. Back in 1999, a chap called Markopoulos worked as a quant at Rampant Investment Management. His boss had just discovered that a very good client was thinking about doing business with another hedge fund manager who constantly produced 1 to 2% returns a month. Naturally, that caused some alarm at Rampart Investment Management, and Markopoulos was asked to design an investment product that could replicate Madoff's amazing returns. So, where do you start if you're Markopoulos? Well, you'd probably try and reverse engineer what Madoff was doing by getting a copy of his revenue stream. That's exactly what happened. However, there was one glaring issue. The return stream rose very consistently, and there were very few down months. Now, I can tell you that this is something that never happens in volatile financial markets, especially over a meaningful sample size. Also, and quite suspiciously, once those returns were plotted on a graph, that return line was at an almost perfect 45-degree angle. Pretty fishy indeed. Things looked even worse when Markopoulos tried to simulate the trades that were claimed. One of these simulations showed that Madoff would have had to have bought more options on the Chicago Board Options Exchange than actually existed. Now, of course, there were no official records indicating that such trades had been placed. So, with findings like that, how on earth was Madoff generating the returns that he and his investors were claiming? Well, Markopoulos guessed that there were at least two ways. The first was front-running, which is essentially a form of insider trading. This is something which many financial firms like Goldman Sachs and Morgan Stanley had been caught doing before. The second was, of course, through a Ponzi scheme. Markopoulos quickly concluded that the latter was the most likely, given that the market never seemed to respond to Madoff's alleged high-volume trades, even though he was supposedly the biggest hedge fund on the planet. So that's why he thought that Madoff wasn't actually executing any trades whatsoever. Markopoulos and his colleagues then filed a complaint against Madoff with the US Securities and Exchange Commission in the year 2000. Ah yes, the ever-dependable SEC that seems to be rampantly clamping down on everything crypto recently, and all in the name of investor protection. But I digress. Back to the story. The Markopoulos complaint was ignored, and they sent another, more detailed warning in 2001, a warning that some journalists ran with. In spite of the numerous articles questioning Madoff's hedge fund, though, nothing was done. Then Markopoulos sent another warning to the SEC titled, "The largest hedge fund in the world is a fraud." Now honestly, this report is a crazy read, and I've linked to it in the description below for you to read at your leisure. In it, Markopoulos states numerous concerns and red flags. The fairly brief summary goes like this. First, he points out that Bernie Madoff effectively runs the world's largest hedge fund, and that it's a little odd how no one knows exactly how much money it's managing. Next, he questions the structure of the so-called hedge fund. Essentially, Madoff was allowing third-party funds of funds and hedge funds to provide his company, Madoff Securities, with equity tranche funding. In return for that, Madoff ran his trading strategy as an agent and generated returns for those hedge funds and fund of funds. The red flag here is that it seems odd that a US broker-dealer would set themselves up in such a manner, unless they were trying to fly under the regulator's radar. Also, it was odd that Madoff would charge only undisclosed commissions for this service, when other hedge funds were charging a standard 1% management fee and taking 20% of the profits. Running the numbers, Markopoulos calculated that Madoff was leaving 4% in annual revenue on the table, which didn't really make sense if you were running a legitimate business. When it came to fund of funds, it was also argued that many fund of funds were keeping Madoff's management of client funds secret. Another red flag was Madoff providing equity tranche funding to a US-registered broker-dealer. Basically, the investment returns passed along to these third-party hedge funds are like Madoff borrowing money. However, the implied interest rate for that was 16%. Now, why would anyone do that? Well, Markopoulos thought it might have been due to Madoff wanting to sidestep the due diligence checks of the short-term credit markets. He also pointed out how successful Ponzi schemes tend to operate in unregulated areas of capital markets, the ones without those due diligence checks. He then mentioned that it was odd that third-party funds were not allowed to name Madoff as the actual manager in their performance summaries. I mean, if you were that good, then why all the secrecy? Wouldn't it be natural to brag about it? Markopoulos then questioned Madoff's supposed split strike strategy, which generally involved purchasing a basket of around 30 large-cap stocks. He concludes that this approach is incapable of generating returns of between 6 and 20% a year. Then he looks at call options and how it's impossible for the OTC market to be several times larger than the exchange-listed market for these derivatives. Doing the maths, Markopoulos calculated that this would have needed to be the case to place those trades for a fund of Madoff's size. It was also flagged that Madoff didn't allow outside performance audits. Yes, there were audits. However, they were done by Madoff's brother-in-law's accounting firm. The words conflict of interest spring to mind. Now, there were in fact many other red flags in this letter, 30 in total, but I think you get the point. Yet in spite of all this evidence and all those red flags, no one in power listened to Markopoulos' warnings. Why wasn't he taken seriously? How on earth did Madoff get billions of dollars under management over decades without the SEC or investors asking any questions? Well, let's find out. First up, you need to understand that there were some very high-profile names who invested with Madoff. These included the likes of the owners of the New York Mets, HSBC Holdings, Royal Bank of Scotland, and more. With those sorts of names flying about, it was easy to see how everyone just assumed that everyone else had done their due diligence. Now, you can check out the full list of Madoff's thousands of investors in the link I provided in the description. I think you'll be surprised by the types of individuals and businesses that fell for this Ponzi. Another key reason why Madoff evaded scrutiny for so long was his reputation. I mean, he was one of the 5 broker-dealers who were closely involved in developing the Nasdaq stock market. In fact, he was also on the board of directors at Nasdaq, on the board of governors of the National Association of Securities Dealers, and a founding member of the International Securities Clearing Corporation in London. Essentially, Madoff had one heck of a financial CV and ran a supposedly legit brokerage, and it was this which made it exceptionally easy for people at the SEC and his investors to assume the industry veteran just knew what he was doing. On top of that, his brother was a financial hotshot too, which just further elevated the Madoff name. In addition, Madoff was also well known in philanthropist circles, rubbed shoulders with the rich and famous, and seemed to have it all. From the outside looking in, no one suspected Bernie of being the criminal he was. Now, you remember that chap Frank DePascali, the guy who helped create all those fake records? Well, the majority of Madoff's clients weren't exactly stupid. It turns out that Madoff's attention to paperwork helped conceal this Ponzi for decades. I mean, investors expect income statements. They expect funds to be deducted from their balances if they make a withdrawal. Yes, those numbers and balances were all in Madoff's head. However, that internal consistency certainly helped the scheme avoid detection. That was probably even more powerful when you combine it with Madoff's stellar reputation. Now, another fact that helped Madoff fly under the radar for so many years was that the returns claimed were perfectly plausible in any given year. I mean, gains of up to 20% seem great and are not overly suspicious in traditional markets. However, it's only when you zoom out and look at those gains over decades that things don't look right. No one can be that consistent all the time. So it wasn't a case that the percentage return which was claimed to be generated in any given year was too good to be true. It was Madoff's consistency over so many years. That's something that's probably very easy to overlook if you're benefiting from those gains. That apparent consistency also feeds into another reason why Madoff probably remained undetected for so many years. He seemed to understand that conservative people are not greedy. They don't hope to make a 10,000x on some random shitcoin. Instead, your average sophisticated investor probably saw Madoff as a conservative way to increase their savings steadily. People like this are investing for the long term. They don't usually hit the panic sell button unless there is blood on the streets, like in the 2008 financial crisis. That all helped keep withdrawals manageable and the Ponzi sustained for all those years. On top of that, Madoff rarely talked about his supposed investment strategy, and the times he did, he was amazingly vague. So that made it almost impossible for people to try and replicate his strategy, unless they went to the lengths that Markopoulos did. Which, of course, in this case, was Madoff's undoing. Now, something else that Madoff did really well was creating an air of exclusivity around investing with him. When it comes to being sold something, exclusivity turns out to be an excellent sales strategy. Just think about those Rolex watches that people seem to drool over on Instagram and the multiple-year wait lists just to get your hands on them. Madoff didn't actually advertise his Ponzi scheme at all. Instead, he would tell friends who asked if they could buy into his funds that they were full and he couldn't help them. "Sorry, Gary, old chap, nothing I can do. Fund is full and there are hundreds ahead of you in the queue." Now, eventually, though, Bernie would relent and do them a favour by allowing that friend to invest that money with him. So, swindling your friends is a pretty horrible thing to do. But if you were like Madoff, you might want to kick that up a notch. As a practicing Orthodox Jew, he targeted Jewish charities and other Jews. An example of that would be making off like a bandit with the endowment of Yeshiva University, one of the biggest institutions for the US Orthodox community. That was also helped by the fact that he was the chairman of the board of trustees over there. But here's the thing, big players in religious organizations tend to avoid suspicion. Also, it turns out that being a philanthropist makes it a lot easier to rob other philanthropists. Another side effect of that is the more philanthropy you're seen to do, the harder it is for people to believe that you could be a crook. Something else that becomes abundantly clear with this story is how suspicions appear to be ignored within the financial system if there is a sizable profit incentive. It turned out that JP Morgan Chase was one of the central financial institutions which enabled Madoff's Ponzi scheme by providing that bank account. That allegation ended up in court, with JP Morgan Chase being accused of putting its own interests first to preserve the decades-long relationship with Madoff. Yes, that same JP Morgan which was accused of billions of dollars in mortgage fraud. The same JP Morgan that paid almost $1 billion to the DOJ for manipulating the silver markets. The same JP Morgan that paid $250 million for deficient risk management practices and insufficient controls. Say, isn't that the same JP Morgan that's led by ardent Bitcoin skeptic Jamie Dimon? Anywho, even though Madoff has departed this world, the fallout from the largest Ponzi scheme in history is still being felt to this day. Who would have thought that an apparently respectable man of the establishment was capable of or had the motive to execute such a brazen scam. Alright guys, that's about all I have time for today. However, I do wish to share a few closing thoughts. The story of Bernie Madoff is a cautionary tale of how the traditional financial system can be twisted and used by the powerful and supposedly respectable people to commit fraud on a phenomenal scale. Indeed, that kind of financial misconduct is probably happening as I speak, probably by a certain bank which shall remain nameless. It's also why I think those ardent no-coiners should take a deeper look into that financial system that they place so much faith in. Yes, as crypto guys, we know the famous saying, don't trust, verify. However, it seems obvious from the story of Madoff that hardly anyone thought that was a good idea when it came to a $65 billion hedge fund. Now, I know that many of the world's regulators are looking at crypto through a fine lens right now. If any of those chaps are watching, I would implore you to learn more about the cryptocurrency space. Yes, there are crypto Ponzi schemes out there. However, just because they exist in this space cannot be used as an indictment of the entire industry. After all, the largest Ponzi schemes ever have been executed in the biggest traditional financial markets, and last time I checked, this wasn't used as an excuse to regulate them into oblivion. Something to think about. And now I want to hear your thoughts, folks. What's your take on the Madoff Ponzi scheme? Have you got any questions? Let me know in the comments below, and don't forget to leave me a like before you go. Remember to subscribe to the channel and ping that notification bell too, and if you're looking for more from the Coin Bureau, then I've got a few things for you. First, there's Coin Bureau clips, the best parts of my channel and social media delivered in bits. Then there's my socials themselves, Twitter, Instagram, and even TikTok. Isn't that swell? I've also got a free Telegram channel where I deliver daily updates you need and a weekly newsletter that will give you the tools, tips, and tricks to ride this bull market like a steed. And last but not least, there's my Coin Bureau merch store that's packed with the coolest crypto sweaters and tees. You can find your way to the rest of my crypto kingdom using the links down below. Thank you so much for your time. Don't stop expanding your mind. You'll be surprised at what you'll find. This is Guy bidding you goodbye.